What is up, everyone, and welcome to another episode of Personal Finance Boss. Today, unfortunately, Ali won't be joining me because he's in Las Vegas with his father. So we will tackle a simpler topic, since doing podcasts alone is a lot more challenging than doing podcasts with two people. And in today's episode, we're going to talk about the risks of investing in stocks, or how do you go about losing money in stocks. Even though this question seems very obvious, it can be interesting to go over all the different ways you can lose money, so that when you start investing in stocks, you kind of have those in the back of your mind, and it can save you time and it can save you money by helping you not make these mistakes. So the first thing that we're going to touch on now is we're going to talk about idiosyncratic risk, and we're going to talk about market risk. Now, these are two risks that we've discussed before in the diversification podcast, but we'll touch on them again here quickly, just so you can see how you can lose money given these two different risk factors. So the first risk factor is idiosyncratic risk. And what this risk is really, if you invest in a single company, you are exposed to not only market risk, meaning how the overall market performs. So, based on economy, based on the currency, based on employment, based on all these different things that impact the market directly. You aren't only affected by those things, but you're also affected by the company itself. So if we take, Apple as an example, and they just launched their new iPhone and people don't like it, or people aren't buying it, the stock price of that stock, or of Apple, is going to go down. And this stock price is going to go down, and Google stock or Microsoft stock is not necessarily going to move because of this event, unless people start buying Google phones, more. But the fact that people don't like iPhones is isolated to Apple. So only the Apple stock will get impacted or get negatively impacted from that, or any other company that manufactures parts for Apple. So, if there's a company that makes the screens, let's say they only made Apple screens, their stock would also go down, because if iPhone sales are down, then they won't be selling as many screens to Apple. It only makes sense. Now, moving on to market risk, what we kind of just mentioned what it was. It's the risk of the market. So overall, if the economy does well, usually the stock market does well. But an example in recent times are the tariffs between the States and China and other countries around the world, and how that creates uncertainty for the countries, and that uncertainty then affects the stock market. Because if you instill tariffs, or if you apply tariffs to imports, then you are going to buy less of the import because it's going to be more expensive. So that will affect the economy of the country that's exporting, and that will affect their stock market. So market risk is generalized. Usually in bad times, all the market's down, and we would call that market risk. Idiosyncratic risk is risk that pretty much pertains to one single company. Another thing, so these are the two risk factors that can make you lose money. If the market's in a correction or in a recession, you're going to lose money. And if you buy a pharmaceutical company that doesn't get their drug approved, for example, that's an idiosyncratic risk, because only that company will be affected. The next thing that we should talk about is correlation. And this is important because it's pretty much the essence of diversification. And if you aren't well diversified, the odds are you will lose more money than you actually have to. And the thing about correlation is, if you buy many assets, so if you buy, let's use stocks as a simple example, you buy Apple, you buy Google, and you buy Microsoft. Now you're thinking, well, these are three completely different stocks because they're different companies, but they're all part of the tech sector. And if the tech sector has an issue, or if there's a shortage of material and they can't produce as much, the revenues go down, stuff like that, all those companies are going to be affected in a similar way if they're all in the same business. So another example is if you buy Ford stock and if you buy GM stock, they're both American car manufacturers. Well, what if there's a recession, or what if there's a new competitor that enters the market and the sales of these two car companies go down? Well, even though they're two completely different companies, they operate in the same industry. So the correlation between the returns of these assets is high. And the way correlation works is, if two things are very much correlated, say cloud cover and rain, then the more clouds that you have, the more chances are that you're going to see rain. Or ice cream sales and the time of year, so in summer ice cream sales are going to be higher. Those two events are correlated. Now, correlation doesn't mean causation, meaning not because, this is a classic example, ice cream sales and drowning are correlated, meaning, well, people go swimming in summer and people consume ice cream in summer, therefore there are more drownings in summer because people are actually in the water, and there are more ice cream sales in summer because it's hot. But it doesn't mean that ice cream sales lead to drowning. So you have to be careful when you just use correlation in your analysis. You have to go a bit more and try and see what the cause of this correlation is. But in our case, when you talk about different asset classes, we talked about stocks in the past, we talked about bonds in the past, we talked about real estate investment trusts, we talked about real estate, we talked about many different investment vehicles, and we touched upon the correlation between these asset classes. And the thing is, even if you go a bit further and you make a diversified portfolio where the correlation among your different asset classes, so bonds and stocks, they're very different, or they're not correlated, meaning the correlation of zero or negative correlation even, that's good in good times, because correlation is one thing in a bull market or in good times, but in a bad market, or if there's a correction, correlation tends to increase among your assets. So if the correlation of your portfolio is, let's say, 0.2%, 0.2 or 20%, and then there's a bear market that comes, the correlation among your assets may go up to 60%, because in bad times, people sell, and some people sell in a panicked fashion. So even though those asset classes won't be affected in the long run, in the short term, people sell because they're scared. So that's one way, or one reason why asset classes have greater correlation in bad times. Okay, now that we sort of address the most technical things, those are, simple, not simple ways, but they are ways you can lose money. If you don't diversify well, and you need to understand that in bad times, your diversified portfolio will become less diversified. Another thing, or another way you can go about losing money in the stock market, is not timing your horizon well. Because even if you do all the best decisions, you allocate your portfolio based on your risk tolerance, based on whatever sort of diversification strategy you have in mind, if you mess up your time horizon, then you can also lose money, because as we know, the stock market is unpredictable. You can invest today and lose 10% tomorrow because you just invested at the wrong time. But if you need to pull that money out in 3 months to pay for your schooling, or to buy a car, or as a down payment on your home, you don't want to put short-term funds in risky assets. So you don't want to put short-term money in the stock market, because on average, if you look at any 10-year period in the stock market, the return is positive. So from 2001 to 2011, positive return. From 1972 to 1982, positive return. But if you look at any given period over 1 year or over 6 months, the return is much less consistent. Sometimes you're going to have positive returns, sometimes you're going to have negative returns, because it's too short of a time period for you to fully take advantage of, the stock market. The stock market is designed for, if you're looking to invest and not day trade, but invest for the long run in retirement and develop a diversified portfolio strategy, it won't be as effective in the short term, simply because you're not giving enough time for your portfolio to work, and you're hoping too much that you're only going to be investing in a bull market, and there's never going to be a correction, there's never going to be a bear market. So that can also be a way that you lose money. Now we're going to totally shift gears, and we're going to talk about how you can lose money without even knowing. If you haven't listened to our podcast before, if you haven't did much research on ETFs or mutual funds, there's a fee. There's a fee behind these funds. Even if you invest in a mutual fund, say you put $100, and after a year the return is 0%, so technically you should have $100. But there's a fee for the company to manage your funds. So if the fee is 2%, then at the end of the year you're going to have about $98. And even though it was invested all year, your return is not zero, it's negative because there's a fee. So it's important just to be aware of what types of fee structures the investment vehicles that you use have. So ETFs usually have the cheapest fee if you compare them to mutual funds, and then hedge funds, are are even more expensive than mutual funds. And we did a podcast a few episodes ago on hedge funds, so give that one a listen if you haven't. But the fee structure there is more expensive because it's investment strategies that they use cost more and require more data crunching or require more analysis, and they're a bit more complex. So just be careful for the fees. The next thing, if you're buying stocks in a self-directed account, you also face commission. And commission meaning when you buy a stock or when you sell a stock, you will be paying. So it's important to go and look how much purchasing actually costs you and how much selling actually costs you. Just to give you a simple example. If you buy, 5 shares of a company for a total of $100, and then those, you make 5% on your money in a week. So now it's at 105, which is great. You made 5% in a week. Those returns are amazing. But you need to also take into account the commission. So if it costs you $5 to buy the stock and $5 to sell the stock, it's a total of $10 commission. And if you look at your $5 gain, it's totally erased when you buy the stock. And then when you sell the stock, you're down another $5. So your 5% return now becomes a negative 5% return. And the reason for that is if you're investing a small amount of money, you need the stock to move up a lot more to be able to break even than if you were to buy 1,000 shares of a company or invest $10,000, because a 1% increase in the $10,000 will generate, say, $100, which I believe, Ali's not here to check my mental math, but I believe it's $100. And then if it only costs you $10 to buy and sell, you still make a profit. But had you only bought 1 share, you'd be making a loss because your fixed costs to trade are high. Sometimes when you trade in high volumes, or at some point when you trade in really high volumes, you'll be paying like, say, 2 cents a share. But for us regular people who don't have that much money to invest, it's usually a flat rate. So $8 fee or $5 fee both ways. On Questrade, which is the platform that I use, you can buy ETFs for free. But when you sell the ETF, you pay double the commission. So this is good if you want to buy, 2 units of the ETF per week, right? It's free every time. But just make sure you don't sell 2 units per week, because then you're going to be paying $20 every time you sell. So just keep that in mind when you trade. And if you trade too much, like if you do 8 trades a day, if at $5 per trade, that's $40 a day that you're losing on commissions. And that can eat up your gains and even eat up your capital really quickly if you don't pay attention. So it's important, go double check how much your broker is charging you to trade. Okay, the next thing that also is linked to your broker is margin. And we've also talked about margin. What it is essentially is it's money, or a margin account, not margin. What's interesting is a margin account. It's an account where the broker will lend you money. So you deposit an initial margin in the account, say $1,000, and the broker would lend you another $1,000 or another $800. It depends on what their initial margin and their maintenance margin is. These are percentages. So if they require that you have 50% in the account as a maintenance margin and initial margin, or let's use different numbers. The initial margin is 50% and the maintenance margin is 30%, just so we don't get confused in the numbers. So if you want to buy $2,000 worth of a stock, you only need to put $1,000 in. 50% of the stock purchase is going to be your own money, and 50% of the stock purchase, the other 50%, is going to be the broker's money, the money that they're lending you in your margin account. And this is great because it allows you to invest more money in the market for cheap because it's not your money, but they also charge you interest on that balance. So if you invest $1,000 over a year at 7% interest, it costs you $70. So just keep that in mind also. Another issue with margin is since you're levered up, or you're using leverage to purchase more of a stock, where you're using other people's money, it is an okay thing if you fully understand what that means, in the sense that if you lose money, so let's say you buy $2,000 worth of a stock, the stock goes down by 50%, so you lose half the money. Now you'd be thinking, well, if I invested $1,000, I get half my money back, so I'll get $500 back. But since you borrowed another $1,000 from someone else, the way it works is if the stock goes down by 50%, it's not the broker's 50% that gets lost. it's your 50% that gets lost. So your return is 100% loss, even though the stock went down only 50%. But that's because when the stock goes down by 50%, you sell the stock, the broker gets the initial $1,000, but there's still a $1,000 loss that needs to be covered. And that's where your money comes in. It's your money that will cover the loss. But usually brokers don't let it go that far because they have something that they call maintenance margin. And maintenance margin, what that allows you to do, or what that sort of indicates is, let's say maintenance margin is at 30%. If the stock price goes down enough where if you look at your stock position, only 30% of the equity is yours, the broker's going to call you and say, hey, you need to put money in the account because the position went down and we're scared that your equity in the position will go to zero and then we'll start losing money. So they're going to make you put money back up to the initial margin of 50% to protect themselves. So leverage and margin accounts are sort of dangerous when it comes to losing money because A, there's interest, and B, there is leverage. And leverage, although it'll multiply your gains, it will also multiply your losses. Now that's important to remember. Now we can talk about more of a psychological thing of trading, right? If you're looking at a popular company, a company that's been doing great over the past 6 months, 2 months, year, whatever, it doesn't matter. And you're like, hey, this company's been doing so great, let me just buy it because everyone loves it. But next thing you know, the bull run for the stock is done and things turn around. And then you're like, oh no, it's going to go back up, it's going to go back up, it's going to go back up. And then you pass your purchase point and then you start losing money on that trade. But now that you lost money, you refuse to sell it. And then at some point when you say, okay, this is crazy, I lost way too much money, you sell it. And then that's when the stock goes back up. Now, this has happened to me 1,000 times. And I try to keep this in mind when I trade. If a stock's been doing well and you miss the boat, don't hop in late because odds are you're hopping in at the wrong time. Same thing goes when a stock is going down. If a stock's going down, don't try to catch a falling knife. Let it establish a base or at least give you an idea of like how low the stock can go before you start purchasing. And usually, or what I would suggest, is that when you purchase a stock that's, it's going on a downtrend, it's a good thing because, hey, I'm getting a bargain compared to people that bought 2 months ago. But you can say, hey, I want to invest $10,000 in the stock. Let me go $2,000 at a time. And even though it's going to cost you commission every time, because every trade, say it costs you $5, this is a way to protect you in a sense that if the stock's not finished going down or if the downtrend is still continuing, you're not going to lose, say, an extra 10% on your $10,000 that you wanted to initially invest. You're just going to lose 10% on the $2,000. And when the stock's lower, you can buy in at a lower price point. We call that dollar cost averaging. We also had an interesting podcast on that, but it's a very powerful tool that you should keep in mind when you invest. Unless you have some thesis and you're timing it, and this is the timing, I believe in it, it's going to work, then sure, go ahead, put all your money in. But if you want to enter into a position, entering into that position over a given period of time helps you minimize risk, because if the stock goes down, not only do you lose less money, but you can purchase that stock at a lower price. Unfortunately, though, if the stock goes up, then you are losing or foregoing returns that you could have gotten had you invested your full amount in the stock at the beginning. But now I'm just explaining ways you can lose money. So I'm going to also show you how to not lose as much money. We're not talking about how to maximize returns, but then again, greater returns, greater risk. So just keep that in mind when you're looking to make high returns or when you want to start getting greedy with your trading, which is okay. But if there's more risk, if the return is higher, there's going to be more risk. So next thing, also kind of psychological, are penny stocks. The famous pump and dump is a great example of how people can lose money in the stock market. So say a penny stock went from 20 cents to 40 cents to 60 cents to 80 cents in the span of a week. And you're like, oh my God, this stock's done so well. Let me buy. Imagine it'll dump. Even if the stock goes to $2, it'll triple my money. It's amazing. Let me do it. It's going to be in and out a week, promise, whatever. And then next thing you know, the stock goes up a little bit more, and then it starts to tank and it goes down very fast. And what investors do is they pump the stock up, take the money, or take the profits, sell the stock, and then the stock tumbles back down. And this cycle can be repeated several times on a single stock. So, I mean, there are so many reasons why you should shy away from penny stocks if you're just starting out. One of them being like, oh, it's a get-rich-quick way, of investing. But the truth behind penny stocks is it's very rare that a penny stock goes from nothing to something tangible. And the scheme of pumping and dumping a stock can also really hurt new investors and really turn them off when it comes to investing because of initial bad first impression or first experience in the stock market. So try not to go into penny stocks too much. I mean, it could be fun. It's exciting. You have some funny money, fun money, call it what you want. You want to do it just for fun, but it needs to be money that you can afford to lose. And just to be safe, expect to lose it. That way, you won't have any unfortunate surprises, right? It's not money that you're using to pay for your kids' college or tuition, Nothing serious like that. Now, the last few ways you can lose money in the stock market that, I think are relevant to us are with buyouts, bankruptcy, and going private. Now, two of these are usually good things. One of these are bad things. We'll start with the bad thing first. That's bankruptcy. Now, bankruptcy is when a company, defaults on their debt and they can no longer make the payment. So it has nothing to do with stocks. But if a company can no longer pay its debts and they file for bankruptcy, many different things happen. First thing, I'm not going to go in detail on what happens during a bankruptcy, but just the most important things are the company's no longer obligated to pay its interest or to pay its obligations to the bank. It's halted for the company to organize themselves. Sometimes they want to restructure, sometimes they just want to close down. And if, let's say, worst case scenario, they close down, then they start to pay off all the creditors. So if you have Bank A and Bank B, one has a senior loan and one has a junior loan, meaning the senior one is the one that gets paid off first, or it can be a secured loan as well. We're not going to talk about all the different loans, but there's a different priority of loans where, Bank A has first claim and Bank B has second claim. So Bank A gets paid off first, Bank B gets paid off second. And after the two or all the loans are paid off, with the remaining money, they have to pay different things like, employee pensions and stuff if they still have those pension plans. If they don't, then, they need to pay off the preferred shareholders. And after those shareholders are paid off, if there's any money left, then they pay off the common shareholders, which are most likely going to be me and you. So if a company goes bankrupt, odds are you're not getting any money because they're going to have to pay off all these people before you and you're last on the list. But sometimes you may get, say the stock was worth $20, they file for bankruptcy, stock tanks to $4, $3, $2, and then they close up shop. You'll get whatever's left. Maybe it's 50 cents, maybe it's $1, maybe it's $5. You don't know. You won't. It's possible that you get zero if they weren't even able to pay off the banks that lent the money and that have that their claims come before yours. But it is possible to get a little something. Now, the two good things usually are buyouts and going private. Now, what happens in a buyout is, say, there's Apple and Google. Google's like, hey, Apple's a great company, I want to buy them. And what would happen is Google would offer, say, $150 a stock. But if Apple trades at $120, that's a $30 premium. So essentially, the stock is going to go from $120 to $150. And then if Google chooses to buy Apple and to abolish their stock and absorb the company, then you'll be getting $150. So that's a good news for you because you made $30 because Google offered to buy the company. Now, if a company, for whatever reason, purchases a company at a discount, which would only happen if, usually it doesn't really happen that way, they're always purchased at a premium, but if a company's having a hard time and they're not making money, management's bad, and the stock price tanks, then that's bad news for you because you're losing money. But since the company is going to be so cheap, a competitor or someone that wants to enter that market may buy the company. And even though they're going to buy the company at a small premium, so the stock price went from $20 to $4, and then from $4, they offer $5. It's a premium, but they're getting that company for much cheaper. And that's a good thing in a sense, but it's also bad because the stock price went down. And then the last thing is when a company goes private. And same thing, the person or the organization that wants to bring the company private will say, hey, we're going to buy all the shares at $25, usually a premium, or always a premium. If not, shareholders wouldn't agree with it. And then they take the company private and they unlist it from the stock market. And it becomes like any other mom and pop shop, whatever, that aren't public. No IPO yet, and none of that. So it's essentially a company before they go public in the first place, a private company. They don't need to report to shareholders. They don't need to file all these different forms to the SEC because they're no longer listed on the stock market. And investors like you and I can no longer buy it because it's private now. And that's one way that you can lose money, but technically you're losing a stock, and usually you make money in these transactions because they're always purchased at a premium. Whew. Well, guys, that's about all I have for you today. Hope it wasn't too dry without Ali here. But I think it's important to go over, the risks of investing in the stock market, so that if you know all the risks, you kind of makes you feel more comfortable, more confident, because you kind of know what to avoid. And the name of the game in trading or in the stock market is knowledge. You need to kind of understand how it works so you can better react and better prepare to what you see in the real world when you actually start trading after reading all these books or looking at papers or listening to audiobooks or podcasts. When you're actually ready to start, you kind of are ready and expect to find what you've heard, and that'll sort of make everything easier. As usual, you can reach us at personalfinanceboss@gmail.com. You can also visit our Facebook page, Personal Finance Boss. Feel free to comment. Feel free to ask us to do podcasts on topics or on interesting books you read and you wanted to get our point of view. That can always be fun because everyone has different points of view. Ali likes, for example, RRSPs. I prefer TFSAs, but they're both great tools for saving. Anyway, guys, I will see you in the next one. Thanks for tuning in.